Awesome. Alrighty, well, welcome back from break, everybody. I hope everyone had a good Thanksgiving. Today I'll be pitching Sirius as a buy for the portfolio and Facebook as a sell out of it. So, an agenda and my investment thesis for each. For Sirius, it's a standalone competitor with a wide economic moat. The company initiatives offer a strong opportunities for growth. It's well positioned to capitalize on industry trends. It has attractive valuation relative to its growth potential, and a share buyback program will serve as a price tailwind and a margin of safety. Conversely, for Facebook, it's overly expensive relative to the industry. There's been heavy insider selling, which is a market signal. There's uncertain growth prospects. It operates in a very competitive industry, and the moat isn't as wide as many perceive it to be. So jumping right into Sirius, many of you are familiar with it. It's a satellite radio provider in US and Canada. It has content ranging from music to sports, traffic, weather, you name it. Primarily in car radios. It's recently made a foray into internet as well, which I'll touch on in a bit. It's got a market cap of roughly $23 billion and shares trading at $375 pop. So how does it make money? Well, Sirius makes 70% of its revenue from subscriptions. This comes from about 25.5 million subscribers, and they've been increasing their quarterly, their subscriber base by 2% quarterly from 2009 onward. And during the same period, they've actually increased the average revenue per customer and decreased the acquisition costs. So from a very topical point of view, it looks good. So diving into the BMVP framework. So as I had mentioned before, Sirius is a standalone competitor. Why is that, you might ask? Well, one, it's very capital intensive. To put the infrastructure in place, that being the satellite, requires a lot of money. And two, you run into government regulations when you're putting satellites in space. So actually honing in on Sirius, we see that they do have strong ties with automakers. In 2012, they had 50 million cars that were Sirius installed, and the company has provided guidance that by 2018, will be over 100 million cars that are Sirius installed. If you take a look at the graph on the left, you'll see that of the 15.5 million new cars sold in the U.S. In 2013, they had a penetration rate of roughly 70%, which means that there is a wide economic moat around their business model. So looking at some of the company initiatives that should propel growth going forward, they have the 2.0 platform, which is the foray into internet radio, which is something that I mentioned earlier. This should allow them to go head-to-head with companies like Spotify or Pandora, not directly in their same space, but should overall broaden their subscriber base. They are continually expanding content. They recently signed an agreement with Fox, and they're targeting some of their content for specific niche markets. One of the big kickers is actually the Agrero Connected Vehicles acquisition, which is a telematics unit. It's a fancy way of saying connected computers in cars. This is actually a long way off before it'll come into fruition, maybe 5 or 6 years, but it's a really nice pairing with Sirius's OEM manufacturing capabilities and their strong ties with automakers, and it's projected that this will be roughly $40 billion industry. So we can see that they are positioned nicely for long-term growth. Overall, business gets an A. Jumping now into management. So something important to know about the C-suite is that they have an owner-like mentality. And on the right, there's a quote by Jim Mayer, the CEO. There are a couple things bolded. The point is that they're taking a long-term approach, and they're not giving hard number guidance, which is important because you don't want to see them misallocating resources to get a short-term spike in the share price. These are all experienced executives. They've been with the company since 2003, 2004. They understand what it takes to move the company forward, and they have confidence in the business, and they've been actually purchasing shares over the past 6 months. Really important, they recently doubled their $2 billion share buyback program to $4 billion, which is good when the company is sitting on capital with no planned use for it. They are returning it. That's something you do want to see as a shareholder. The one caveat to all of this is that Sirius is subject to majority control by Liberty Media. However, I don't see that as an overriding concern. So overall, management gets an A-. Looking now to the financials, it's a quick snapshot of what 2013's looked like so far. You see that there's healthy revenue growth, healthy EBITDA growth, and margins are actually increasing. Actually, I expect the margins to increase even further, as in the beginning of 2014, they're increasing the price of their core service by 50 cents, which should further widen these margins, which is a good thing for business. So turning now to the balance sheet. They do have a cash position of $700 million and a debt position of $3.7 billion, and at first that's a little bit daunting, but when you take a look at some of their competitors, you see their debt to equity ratios aren't so out of line. And this is we're actually given more reassurance by the fact that you look at their cash flow. You see that they are growing their free cash flow continuously and steadily, and this should give them financial flexibility to refinance debt, make acquisitions, or return additional capital to shareholders. So overall, I give balance sheet and their financials a B. Taking a look at the price, you see that during 2013, the price is appreciated substantially more than that of the S&P. And when you actually boil that down and you look at the valuation metrics, it does kind of appear that Sirius does have a rich valuation relative to its competitors. However, I contend that the growth potential adds more to its implied fair value than is currently being incorporated. And if you take a look at Pandora, something that's not exactly in the same space but has relatively the same kind of growth potential, you see that the metrics aren't so out of whack. So overall, I give price a B+. So turning now, look at some of the industry trends. One of the things we've seen is that global radio and subscription revenue has been growing dramatically and should continue to grow dramatically as cited by PwC. There's been rebounding auto sales in the US, which is of course good for business, and there's actually an increasing percentage of Sirius-equipped automobiles on the road. As I had mentioned before, there's about 50 million Sirius-equipped automobiles, and this is actually really important as they're now reaching critical mass whereby they're going to have access to a very large secondary market that they weren't previously able to access, which should further drive growth. So, there are some risks to this investment. There could be a sharp slowdown in automobile costs. They could have increased content costs. That's Howard Stern. Many of you may know him. Or 4G alternatives in car, but those have yet to kind of manifest themselves, so I'm not too concerned. However, there is a very strong margin of safety, the strong economic moat around their business model, their growth potential coming from both company initiatives and from the industry in which they operate, and the large share buyback program. So, transitioning now into Facebook. So all of you know what Facebook is. It's a social media company. To give you kind of an idea of what the business is, they have roughly 1.2 billion monthly average users, and the revenue is derived almost in equal parts from mobile advertisement loads and desktop advertisement loads. And actually the mobile load is something relatively new for Facebook, something that they weren't previously able to monetize. So jumping to the BMVP framework. So business, 89% of their revenue comes from advertisements, which wouldn't be a bad thing except for the fact that this is a very competitive industry. And this is where the fact that their economic moat not being as wide as perceived really comes into play. What do we know about social media? One, there are almost no barriers to entry, and it doesn't cost the user anything to switch. And this is something that we found in the third quarter report, whereby Facebook cited that usage among younger teens was down. And this isn't to say that Facebook isn't in any way in dire straits, but rather now that they've seemingly reached this threshold with younger teens, we might see their total growth in user base slow as well. So, kind of continuing on that note, there's only so much capacity Facebook has to post advertisements to its website, and they actually said they won't increase the frequency in which the advertisements appear on your mobile phone, so its growth potential is kind of obscure. Well, what has Facebook turned in the past? They've looked to acquisitions to grow their user base. One, this is very capital intensive, but it's also very risky in the sense that being able to effectively monetize that isn't an easy endeavor, and that's not something we've seen out of the Instagram acquisition. So, kind of a standalone issue as well, we see that when you're privy to this kind of information, personal information about people, there's data management and privacy issues. So overall, business gets a B-. Turning now to management, Zuckerberg's been massively successful thus far, but he does control over 50% of the voting rights, and he's also appointed more than half of the board of directors, meaning that he essentially has autonomy to make decisions, and we've seen strong insider selling. I'm going to hurry up now. The balance sheet is good, it gets an A. Price, so it's roughly $46, near an all-time high. Based on a PE/PS ratio, I calculate a fair value of about 33, which means there's substantial room to run. And just to be very clear, I'm not suggesting that Facebook's a bad company or it's going to tank. I'm saying relative to its revenue and its growth potential, these lofty valuations aren't supported, and now would be a good time to exit our position.
Thank you.
All right.
Questions? All right, back here.
Did you take into account Facebook's acquisition of Instagram when you were doing your growth estimates and valuation?
Yeah, I mean, they've yet to monetize that. And where and how they're going to do that is still up in the air. Yes, it was a factor, but actually putting a definitive number on that wasn't actually in the calculation.
You talk about with more and more cars having Sirius installed in them. They also are having more Bluetooth installed with them too. Do you think that's sort of maybe jump in that barrier to entry a little bit when someone can just put on Pandora on their phone with Bluetooth and have it play through the car? I mean, is that? I feel like that's something that's kind of coming into cars at the same time with Sirius.
Yeah, so that's naturally like a competitor, but their telematics offering is actually going to address that head on. That's actually with the Bluetooth, all of that, as sort of a counter offering to that.
Of the 50 million cars that it's installed on, how many are active, paying every month for Sirius XM, the radio?
50 million is installed. They have a conversion rate of about 45%. So, yeah.
Does Sirius have any is it looking to go into other markets outside of the United States and Canada?
Yeah, that's actually a good question. They were exploring that, but actually getting the infrastructure in place is very capital intensive. I think they're looking to do that in the future, but right now they're focused on growing their product in the U.S. and focusing on this telematics offering as well.
All right, I'll ask a question on Sirius. So yesterday, SpaceX put a satellite into space, communication satellite, a third of the cost generally or less than Sirius probably has done. I know it's pretty recent, but has Sirius said anything about that as a barrier to entry being decreased, that other people can get satellites now more cheaply than maybe they have in the past?
No, they haven't. The company hasn't cited anything particular. They actually recently put up an additional satellite, meaning they should be positioned with all the infrastructure they need for the next 10 years or so. Sure, somebody could probably enter into the space, but to get to the place where Sirius is at in terms of his business isn't something that's going to be easy to replicate.
Other questions? Thank you.
Thank you. All right, here we go.
All set?
Ready when you are.
Good afternoon. Today I'm pitching a buy for Infinity Pharmaceuticals and a sell for the iShares Emerging Markets ETF. Infinity Pharmaceuticals is a drug discovery and development company. They focus mainly in the oncology space. Sort of an industry overview of U.S. pharmaceuticals. They've been handling the generics patent cliff relatively well, better than most expected. Lower prices and higher fees are something that the industry has had to absorb in exchange for a considerably larger customer base under the ACA. So this is something to keep an eye on going forward. New products and aging population mean a robust future for the industry, most likely. And the FDA's approval rate for new drugs is at its highest in 15 years as of last year, a good chunk of which were oncology drugs. So taking a look at the business, they develop best-in-class cancer drugs primarily. They look to serve underserved or undermet medical needs. Right now they're focusing on lymphoma and blood cancer. They have several promising drugs in their pipeline that will likely come to market in around 2020, 2025, all with a high likelihood of commercialization. They're also excellent at managing strategic alliances with other drug companies, research facilities, colleges, universities, government, things like that. And you'll see that 40 to 80% of their R&D expenses are currently reimbursed through these strategic partnerships. It's something they've really done very well with. So here you can see in FY11 and 12, that revenue was derived primarily from reimbursements through research and development partnerships, as well as milestone payments for some of their headline drugs. In my projections, I didn't include any revenue for 13 on, just because the milestone payments and these reimbursements are all conditional. And while it's likely that they will receive some from particularly Millennium Pharmaceutical, one of their chief partners, I wanted to go with the conservative route. But they do stand to gain as much as $350 million in milestone payments over the next 10 years. Their best front-runner drug right now, IPI 145, has an 80% likelihood of commercialization for lymphoma. It's about to enter phase 3 FDA testing. And if you're familiar at all with the FDA testing procedure, an 80% chance of commercialization is very, very high. And they're not a single drug, one-trick pony. They have other drugs as well. This is the one I chose to focus on because it's the most promising over the next 5 to 10 years. So as you can see, here's their key product pipeline. They have most of the drugs are in phase 1, about to enter phase 2, and IPI 145 actually is entering phase 3 this month. So management, they have a high ownership of company stock. 16% of shares are held by insiders. They have demonstrated an excellent ability to manage strategic partnerships, and again, really stay on top of those milestone payments and reimbursements for R&D. And the executive team is experienced. They've all come from either a medical background or drug research background, so they really are on top of things. Looking at the balance sheet, they have a very, very strong cash position. As of the end of 2012, they had $350 million in cash and cash equivalents. It's gone down a little bit just because of the drop-off in milestone payments and R&D reimbursements. Very low liabilities. It's all short-term accounts payable. And the gap between their reimbursements and milestone payments and their R&D expenses, which is most of what they're spending their money on, is funded through a pretty large capital surplus. So taking a look at the price and valuation, the current price has been hovering around $14.50 for the better part of the last month or two, which is near the bottom of the 2-week range. You can see the bottom was $11.57, and the top back in 2012 was around $50. So I've put a price target of $36 for the next 5 years based on the promising drugs that are in development. Some of the risks, results to date on many of the drugs, even though they're very promising compared to their competitors and other drug development companies, it doesn't guarantee that these drugs will go to market, so that is a risk to keep in mind. Their operating losses are probably going to continue into the near future and medium term, just because that's the nature of the business. And once the drugs are commercialized, there'll be a big payoff. That being said, after regulatory approval, if doctor and patient adoption is for some reason not high, which is anticipated to be high because there aren't really any direct competitors to IPI 145 at this time, that would present a risk in terms of not sort of recouping those losses over the life of the drug. And then, of course, uncertainty surrounding ongoing healthcare reform is always something to keep in mind. So transitioning to the iShares MSCI Emerging Markets ETF, I think that we should sell this on weak economic data coming out of the emerging markets that are represented by the fund, as well as sort of how I think the U.S. markets will respond to a drawdown in Fed activity in the near future. So sort of the emerging markets overview, investors are pulling large amounts of capital out of the emerging markets, and they're parking it in highly levered bearish ETFs against emerging markets. There's a liquidity squeeze in most of these markets that are represented by the fund. The currencies are weakened, and there's a curve in the global goods demand coming out of these countries, which has a lot to do with low oil and corn prices in the U.S. So some threats to the emerging markets performance include steep capital withdrawals, as I mentioned. Any move by the Fed, if we've been tracking that over the last semester, is usually amplified in the emerging markets compared to the U.S. And I think that this would sort of be one of the first places investors return to draw capital away should the Fed announce drawback in their activities. And then the interconnectedness to the Chinese economic performance in pretty much all of these markets, I think, represents a much greater risk than is often given credit for, just because there's so much shadiness going on with Chinese economic policy. A lot of these big countries, especially Brazil, which is heavily represented by the ETF, are directly related to what's going on in China. So this sort of infographic is from the Wall Street Journal, and it just shows some really interesting figures about the economic data that's been coming out of these markets lately. And you can see like manufacturing activity, for example, down in Japan, Germany, India, and Mexico, which are both in the fund, especially India, China, Brazil, both heavily represented, sort of slumped. Doesn't really support the price level of the ETF's been at, I don't think. So the fund management, it's lopsided. I think the allocation of funds within the ETF is somewhat lopsided towards the financial services industry in these emerging markets, as well as towards South Korea and Taiwan. Those two in particular sort of seem to be overly heavily weighted given the nature of the fund. I don't think that's a risk taken into consideration. So the current price is around $41. And like I said, the economic data coming out of these emerging markets, I just don't think is strong enough to support the current price levels, which are almost double pre-2008 levels. And again, uncertainty surrounding the Fed activity in the near future, I think, poses a great threat, and is probably the chief reason in conjunction with the weak economic data why we should sell. So like I was saying, you can see we're still at around pre-recession levels, and I just don't think that's supported. Some of the risks include delayed Fed action, which seems to be more and more the case the last few months. So we could see some more upward trends in the ETF if that's the case. Especially Yellen's recent promise to stay the monetary course. If that means the Fed's not going to take away the punch bowl for many months or years to come, then that could mean better performance than I'm anticipating. And then also economic reforms coming out of China, Brazil, India could mean that these emerging markets would have time to clean up their sort of the mess and lessen their reliance on the U.S. monetary policy before it's too late. So in conclusion, buy Infinity Pharmaceuticals. You can see the grades there, and then sell the iShares Emerging Markets ETF. Questions?
Thank you.
Sure.
It seems that Infinity doesn't actually have any products that are like approved, and it would follow that it hasn't actually sold a drug.
Sure.
How and when do you estimate them actually selling drugs, or like at what point in the future do you realistically say it might?
Sure. So the nature of the company, since they're a discovery and development company, they have agreements with larger pharmaceutical companies who have the patent for these drugs. Right now, the biggest agreement is with Millennium Pharmaceuticals. And so they do, it's structured such that they do the research and development for these drugs and sort of bear that burden in exchange for a pretty large royalty when and if the drug goes to market. So the most likely candidate right now, IPI 145, of which it's in testing for multiple different uses right now, lymphoma being the leading one. There's an 80% likelihood of commercialization, and peak sales would probably come around 2020, 2025.
I guess what I'm asking is like how you come up with that stuff.
So that's based on sort of other drugs that have come through FDA testing in the last year or two, and also the fact that the oncology drug market is or oncology patients are sort of underserved right now, and so that's why you're seeing a lot higher FDA approval rates for drugs like that.
They've invested their own money in the initial stages of the R&D, where they seeded by, for example, Millennium Pharmaceuticals, and then continue.
So it's both. So they establish these strategic partnerships with the larger pharmaceutical companies like Millennium, and based on their progress on the drug and what they call milestone payments, they're receiving sort of conditional payments and reimbursements from those companies. But the gap, which has grown a little bit over the last year and likely will continue to grow a little bit going forward, is financed through their own money.
terms of R&D, in terms of the total amount of R&D dollars you spend, was there a return for the R&D dollars?
So there's not, it's hard to really give a figure for return now just because the drugs haven't gone to market. But I can tell you that in past years, I'm not sure what happened to the number, it's been 40 to 80% of the R&D expenses have been reimbursed through these partnerships. So that's sort of the closest I could give you to a return figure right now. Other questions?
Other questions? Okay,
Thank you.
All right, sticking with pharma here.
Yes, sir.
Go ahead.
Okay. So I'm pitching that we buy Jazz Pharmaceuticals and sell White Wave Foods. Jazz Pharmaceuticals is a specialty biopharmaceutical company which focuses on identification, development, and commercialization of pharmaceutical products. So its main product areas are drugs for narcolepsy, oncology, pain, and psychiatry. They currently have a few drugs out that are making big profits, mainly for narcolepsy and oncology. In January of 2012, they merged with another pharmaceutical company, Azure Pharma, which basically doubled their size, gave them a lot of international experience. And then in June of 2012, they acquired USA Pharma, which specializes in oncology and critical care, and they paid $670 million in cash for it. So upon completion of these mergers and acquisitions, they gained several specialty pharmaceutical products, but also they got a better management team from USA and Azure, and a stronger international distribution network. So now they're based in Ireland instead of in the US, and they have a very substantial portion of their sales coming from Europe. So some of the risks I'm going to go over first. They have substantial competition from other large pharmaceutical companies. They're pretty small in the industry. Their market cap is only $6.3 billion. And 16 companies are bigger than them, so they have a lot of competition, but their products have been showing substantial growth. Some of the other risks, they have all their products face the possibility of generic versions being released. So the products have been out for a few years now, so coming up, companies can start making generic versions of the products, and so they can start to lose a lot of their sales because generic versions are cheaper. They also depend on single-source suppliers and manufacturers for their products. So the loss of any of these suppliers can cause serious problems or delays in distributing their drugs. Additionally, they have the healthcare law and policy changes. They're not really sure how it's going to affect them as of yet, but based on other healthcare law changes in the past for other pharmaceutical companies, it could have either a really positive impact or it could go really south for them. So for their financials, their PE is about less than half the industry average, so they're very cheap. And they have crazy revenue growth, 65% 3-year average. They also, their ROE and ROA are much higher than the industry average. So they're just starting out, but they're looking pretty good. And these numbers are for 2012, but this past year they just released their quarterly report. So the 3 and 9 months ended September 30th. Their total product sales increased by 32% and 58% respectively compared to the same time in 2012. And sales of their lead product, Xyrem, which is for narcolepsy, increased 50% and 53%. And then outside of the U.S., their second biggest product, Erwinaze, sales increased by 39 and 34% during those periods. Also, since their merger and acquisitions, they gained the oncology products, and so now they have a more diversified product line. Beforehand, they were just counting on the Xyrem product, which was like basically all their sales, but now they have a few more products, so now their main product is down to 65% of sales, and their second most popular product is like gradually increasing its sales, and so they're more diversified now. And so for myself, I want to sell White Wave Foods. They're a consumer packaged foods and beverages company. They specialize in plant-based foods and beverages, coffee creamers, and premium dairy products through North America and Europe. Currently, their products are positioned in rapidly growing on-trend categories. The plant-based foods and beverages represented a $1.9 billion category in U.S. and Europe in 2011, and in 2012 it increased another 18%. And the U.S. household penetration for refrigerated plant-based beverages grew from 16 to 25%, so that's like Silk milk and drinks like that. So some of the risks, they also, like Jazz, face strong competition from much bigger consumer packaged companies like Dannon, General Mills, Kraft, Nestle, which are pretty big heavyweights. So this is a really big disadvantage for them because these competitors have much more money and resources, and so they can innovate products more quickly, get products to market better, market better. So the other companies are in a much better position. Some other risks, they don't enter into written agreements with their customers, like Walmart and Sam's Club, which are their two biggest customers. They have like 50% of their sales from those two combined. So they don't have any agreements with them. And so if Walmart or Sam's Club decide not to sell their products anymore, they'd really be screwed. Their business also depends heavily on the raw materials to make all of their beverages and foods, and which come from third-party suppliers, but they don't have strong written agreements with their suppliers, so they're not assured of continued supply or a consistent price or exclusive access to those materials. So for the financials, their PE, they're kind of expensive compared to other companies. Their stock price has gone up a lot in the past like 2 or 3 years. So I think now it's a bit of where it should be. So I'm expecting it's going to come down for the next year or two a little bit. Their interest coverage kind of scared me. Surprised, I guess, because of the big competitors like General Mills and Kraft. The interest coverage is much higher for those because they have a lot more resources. And for White Wave, they have a lot more debt compared to the amount of revenues they're getting. So if one of their customers decide not to sell their products anymore, like Walmart, Sam's Club, they might not be able to pay off all the debt they have. Also, they have a lot of debt. They have $723 million in debt, and in their annual report, they're saying that really detracts significantly from projects they can invest in using cash flow from operations. So they're really limited right now unless they take on more debt, which they're having a hard time paying it off already. So Jazz has had crazy revenue growth in the past few years. Its revenue for 2012 was 500 million, and in 2011 it was only 250 million, and the year before that it was only 120 million. So they've been like doubling each year. Especially pharmaceuticals is an up-and-coming industry, and Jazz is way cheaper than other pharmaceutical companies. And then for White Wave, I think we should sell them because I believe they're too expensive. They have low ROE and ROA, and the industry has really high competition with really low profit margins. So although White Wave is a good company, they've had revenue growth every year, I just think that Jazz would be a better company in the portfolio than White Wave.
Thank you.
I might have missed this, but what do you think Jazz is doing to kind of sustain a high growth rate in the long run?
They have a lot of, or they're trying to license, or they're trying to grow long term through acquiring or in licensing other products. So they're looking to make more acquisitions. They've already made 2 in the past year or last year. So acquiring is a big thing, but they also have a few products in development. Some for narcolepsy, and the pain meds are in trials, and they're expected to be released to the public in a few years. So, yeah.
Of the main drugs, particularly the one you mentioned is 65% of their revenues, how long do the drugs have left in the patent, and what's the risk of involvement there?
Can you say that again?
So the main drugs that they're selling, particularly the one you said is 65% of their revenues,
Yeah.
how much longer do they have on that drug patent, and what do they do with the manufacturer?
I think they have around 7 more years, but in their annual report, they're talking about how in the last few years of the patents, a lot of companies will make generic versions of the product, or like a really similar product, or just plain copy it, and then they'll start to sell it, but it takes time for like the FDA and Jazz to like press charges or get like patent lawsuits and stuff to get it off the market. So
If Jazz really does have this really strong growth potential, like we're mentioning, why do you think it's priced so cheaply?
that is a very good question. I'm not entirely sure. Their stock price has gone up a lot the past, I guess, year or two. But I think they just have a lot more growth potential. Like their revenues are only 500 some million compared to the big competitors, which are like billions and millions of dollars. And I think they're showing that they're going to release more products. They're going to keep growing. I think they have strong potential. I don't know if that answers the question.
With 7 years left on that biggest patent they have, do you anticipate for like 5 years they're going to still have that same level of revenue growth on it? Or is it going to eventually tail off? Or is it going to be saturating the market enough?
I think the next 3 or 4 years, you can expect similar revenue growth for those products. But then once generic versions start leaking out, then sales are going to drop off. But by that time, they should have new products ready to be commercialized. They have a lot of products that are already in clinical trials and are getting close to being approved by the FDA. So.
Can you maybe talk about the drugs that are in the pipeline? Do you have some color on those and the ones that are coming next?
They have some for, I don't know the names of them, but for narcolepsy, they have another drug coming out that's in trials. A company they acquired last year that specializes in oncology had products in development that are also reaching clinical trials. So those are expected to come out soon. Yeah. That's overflowing out, kind of keeping it on the down low.
Other questions? Thank you.
I did some modifications.
No modifications.
Hi everyone, Sanal Patar, and here are my stock pitches. I'm proposing to sell Philippines ETF and buy Solar City Corp, which is engaged in solar industry, energy industry. I want to start with Philippines ETF. This is basically ETF that tracks Philippines market. The underlying index is a market cap weighted index that measures the performance of equity securities that listed on the Philippines market. And as you can see, the majority of its sectors are in financial, industrial, telecommunication services, and so on. And here's a quick detail about the fund. The stock is it's listed on NYSE RKX. Net assets almost 300 million. PE ratio 23.47. So number of holdings 41, and beta versus to S&P is 0.97. And I believe we should sell this ETF because U.S. Fed's taper plans may put pressure on the Philippines financial market in the near future, and the country's benchmark interest rate is at all-time low, and it is typical during the credit bubble where there's a consumer spending grows at rapid speed and personal savings decrease. And household debts are at 35%, and the Philippine Central Bank's been using this as one of their major factors to encourage banks to lend more aggressively. And this is quite alarming because it is similar picture to the pro-credit growth policy during the credit bubble in 2002. And BNBP analysis, I gave C+ for the business. It's dependent on the U.S. Fed policy and foreign direct investment, and also the country's economy is heavily engaged in a few key trading partners like China, Japan, and U.S. Management C+. Interest rate is at all-time low. Interbank lending rates at record low. Balance sheet B. It looks quite good. Economic data. Currency rose by 25% since the recession. M3 money supply doubled, and price valuation trading near 52-week low. But the conclusion that I made was that the country has a property bubble in addition to its credit bubble. And here are some supporting charts. You see the stock market tripled since the recession. The government bond bubble they're benefiting the emerging market bubble as well. The yield is at 361, if I'm not mistaken. Interest rates been low, falling as well. External debt spiked during the recent years, and exports been falling. This is the percentage compared to its GDP. And here's a chart about property prices in the last few years. Solar City Corp. It's a company that designs and installs, sells, or leases solar energy systems to residential and commercial customers. The company is up more than 300% since the start of the year, and is expecting big time growth next year. It raised 54.4 million last Thursday by selling first notes backed by the rooftop solar system installed across the country, and it has a 4.8 interest rate and is scheduled to mature in 2026. And they also are planning to sell 200 million more by the second quarter next year. And the need to raise this capital is that the company is relatively low and it's not making enough revenue to cover the cost of their solar panel installation and to keep up with the demand. And another reason to invest in it is that they have advantage in their business model, which can they build all the equipment and they take care of all of it. You just have to lease or just buy the energy. And also the California's new energy policy states by 2020 all of the utilities that are being used has to have 33% from renewable energy. And last week company expanded big time in California, and they're predicting that they will lower the cost, maybe comparable to regular power or even cheaper. And last, Walmart, it's their biggest customer. They worked on a few projects in the past, and the future plans it made for the sustainability goals draws a positive picture for Solar City's future. The business aid, because of their business model, raised management aid raised 54 million in bonds and planning to raise 200 million more. Balance sheet looks quite good, beating the expert estimates. Price valuation, they last week they received S&P BBB plus rating on securities, and this is a big step because getting an investment grading is going to significantly lower the cost of capital for the company. And considering the business model and future plans in the long run, I believe that the company has much more potential in the future.
Questions?
Solar City uses consultants to sell their solar panels and whatnot, and they're now transitioning to more of a network marketing approach. Do you think that's going to change their business model or kind of their growth and their revenue and whatnot, or is that going to help them help propel them forward?
Sorry, could you?
So the Solar City just had a partnership with a energy company called Viridian, where they're transitioning to more of like a network marketing approach to selling their solar panels. Do you think that's going to change their business model at all?
I mean, it's definitely going to benefit them in terms of cutting the cost, probably. But other than that, I'm not really sure.
Question.
So, for the Philippines ETF,
Yes.
an expanding economy usually translates into growing house prices. So, other than the fact that house prices have increased, what makes you think it's going to be a bubble, or it is a bubble? And what do you think the catalyst would be that would burst the bubble, and the effect if it does burst? This is kind of like a three-part question.
Well, the most of its income or the prosperation of its economy is dependent on the cheap credit that's coming from cheap investment. And if it's going to burst, it's going to probably depend on its key partnering countries' economies, policy, or U.S. Fed policy, I guess. And what was the first question?
What do you think that the result would be if it does burst?
We're gonna have a credit crisis, I guess.
Question here.
Do you know how they beat their estimates for most recent quarter so much? With like the estimates were $1, and
Solar
they
City?
earned $2.28, I think, sure.
Sorry, Solar City?
Yeah.
I don't have the numbers, it's on the sheet, but
I mean, do you know what drove such a big, exceeding of expectations?
big growth, like 300% since the start of this year.
Yeah, I mean, just in terms of like what the analysts are estimating $1, but they're getting so much higher than that.
I'm not really sure.
On Solar City, you mentioned the fact that California has a mandate to have a third of their power be renewable. That's a good tailwind for them. Are there other states where there's similar opportunity, or other states where it's a headwind, where they're getting cheap energy, for example, from natural gas that makes them less competitive? What's the landscape look like outside of California?
I believe they are operating in 25 to 30 states so far now, but they're putting most of its emphasis on California because it's where they based and where they started off and where they have the most market in that state. But other states, I'm not sure.
Other questions?
Can you talk a bit about how you think about valuation for a company like this?
For Solar City,
Yeah.
what do I think about the evaluation?
Yeah. How do you approach it? How do you think about it? How did you get around, given where it is in its growth cycle?
Sorry, I don't get the question.
That's great.
Other questions? Thank you.
All right.
Hello, my name is John Jen. I'm here to propose a high recommendation for Toyota Motor Corporation and a recommendation for pharmacyclists. Because of the economic downturn and recall incident that happened in 2009, Toyota Motors experienced a difficulty starting 2007 until 2009. However, the corporation recovered to a large extent, its gross revenue reaching a peak in 2011 and on May 2013. It has overtaken BMW as the most valuable car brand in the world, according to a study released by Millward Brown. It is evident that the corporation has recovered its damaged reputation from the recall incident based on its revenue growth since 2010. Analysts predict that the revenue will continue to grow until 2016. Some critics might argue that Chinese consumer demand might slow due to the ongoing political tension between China and Japan. However, Toyota Motors sees the next wave of growth also from developing markets in Southeast Asia and South America. Toyota's image as no frills, low maintenance, good value product resonates well with the demands of customers in the emerging economies. For EBITDA margin, I compare Toyota Motors EPS with that of Honda, Ford, and Hyundai. Ford EPS shows decreasing trend since 2010, and Honda's EPS increased 40.16% from 2010 to 2011, but it dropped 32.26% from 2011 to 2012. Lastly, although many consider Hyundai as Toyota's primary competitor, Hyundai's EBITDA project to grow, but the rate is much smaller than that of Toyota. Hyundai EPS is projected to grow 8.69% from 2013 to 2014. I would like to emphasize once more that the company was resilient in the last 3 to 4 years, and in the next 3 to 4 years, the growth is expected to be larger. That margin of the company has increased from 9% in 2010 to 12.5% in this year, and it expects to grow up to 16 to 17% range. Toyota Motors EPS has shown tremendous growth in the last 3 to 4 years. In 2010, it was $1.44, and in 2013, it reached the level of $6.45 with average 120% growth from 2010 to 2013. The corporation expects to grow at 30 to 40% in the next 3 years. In my opinion, having a stable EPS growth reflects strong management and high payout ability. Toyota's free cash flow declined from 2011 to 2012 and increased from 2012 to 2013, not reaching the 2011 level, but it projects to get a growth beyond 2011 level in 3 to 4 years. In addition, I use equity value per free cash flow to evaluate Toyota. If a company's EV per FCFF is lower than EV per FCFF or benchmark, then the company is undervalued. Likewise, if the rate is higher, then company is relatively overvalued. Toyota's 2012 value is at par with the industry, for its value was 20.52, where the industry rate was 20.77. So the Toyota stock is slightly undervalued. for the region, each green signal to recommend Toyota stock. Lastly, interest coverage ratio of Toyota is at 72.2 times, which I consider a very healthy rate, and the debt equity ratio is stable at 1.16 in comparison to an accepted ratio of 2 to 1. Ford's ICR is 3.16 times in 2013, and GM's ICR is minus 85.24 times. Hyundai's ICR is 28.78 times. This data is a strong indicator of Toyota's excellent management of debt and its control of borrowing to maximize its stock value.
2 minutes.
Now I would like to discuss why it be beneficial to sell pharmacyclics. The price earning ratio of the company is 73 to 0.2, above the Standard Poor 500 ratio of 17.7. Share prices are at an all-time high of $123, and many are saying it's a buy deal.
One minute.
The company's strengths can be seen in multiple areas, such as its solid financial position with reasonable debt limit, notable return on equity, and expanding profit margins. As a counter to these strengths, we also find weakness, including unimpressive growth in net income, weak operating cash flow, and feeble growth in the company's earnings per share. Revenue per employee reflects productivity. The company is doing well compared to other companies, but
Questions?
So you talked a lot about potential growth for Toyota. What do you think will be the major catalyst for growth going forward? What do you think is going to drive growth for Toyota going forward?
Toyota has huge potential growth in emerging markets, such as Indonesia. In April 2013, Toyota opened its first auto plant in Indonesia. As car sales, the country, Indonesia is expected to overtake Thailand. Thailand is the biggest market in the Southeast Asia. So,
I'm not sure if you mentioned this, but what are the risks of getting both or motorcycle?
There are some risks. like increasing competition and dependence on economy and consumer confidence.
I have a question about pharmaceuticals. Your overall grade on your executive summary is actually pretty good. So if you had to really, would you recommend we actually sell it because it's closer to all-time highs? Do you think we should hold on? Because you mentioned in your key risks that there is considerable future long-term growth. So do you think it's worth holding the position and see where the stock goes in the next 6 months, or do you think we should sell our position now? Gut feeling kind of question.
I don't think so.
And given the rapid growth of the healthcare industry and pharmaceutical industry as a whole, I mean, I guess I'm just wondering why, why you're recommending pharmaceuticals to sell, because even on your sheet you give it pretty high growth rates.
Yeah.
Yeah, growth rates as well.
But as I said, the company has weak operating cash flow and like the earning per share is not that high.
Other questions? If not, thank you. Okay, we're through half, so we'll take a quick break and
5 minutes, be back, because we need to jam through. So
yeah, we have plenty to do, but take a
it's
quick
2:01.
break.
Be back. Should be back at 2:06. Thank you. Good. Oh, nice. Yeah, that's
That's awesome. That's awesome.
I did not have it. I looked at my.
No, I saw it.
Yeah,
So she knows how to use it.
after gauging,
Yeah, it's good.
opportunities out there and sort of improving. I have not yet. You guys don't know about that.
We did, yeah. So
Okay.
let me know what you apply for.
Okay, yeah, absolutely.
So let us know this team, and then we can maybe, no guarantee.
No, that's fine. Anything to help find, get it.
I think Rodney can get you a job, no problem.
What's that?
I think Rodney can get you a job,
Oh,
no
there you
problem.
go. Can you get that on paper, please?
I guarantee.
Exactly.
Nice. Like,
With
it's
good
just-
benefits.
Yeah, it's just something where it's like, it's right, that's a learning opportunity right there.
No, I think it's a good spot.
Instant feedback working there too, so.
I think it's cool.
Yeah.
Where is it?
Mount Cool,
Oh, nice.
yeah.
So, yeah, send over what you did.
Yeah, sure.
We should try to help that team.
Great, appreciate it, thanks for the time. Yeah, I think it's just something where I was like, gauging where I'm at right now,
Yeah.
and sort of like, like I said, the opportunities out there.
Yeah.
It's just something that sort of made sense, and
Yeah.
I think it's a great opportunity. Kind of,
It's a cool flip.
that's the thing. It's like, that's where I got started with this stuff. Was my dad had those newsletters like 10 years ago, and just was reading about like Whole Foods or something. That kind of spurred me on with this stuff. So,
That office.
yeah, out in Alexandria. Yeah.
We're actually considering doing a financial.
Cool.